Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Thursday edition, a very exciting Thursday edition to be sure. Maybe we could start to prioritize the content, the people we have, and the things going on in our markets today, and maybe make a checklist of how exciting the things are. For example, you would think that the most important thing of the day was Robert Prevost, a Chicago bishop, becoming the new pope. We have Pope Leo the 14th, but no, that's not that important. And you could maybe think it's the breakout of Bitcoin to the upside, as we've been talking about. As I said, I think we're getting to 108 by the end of this month. But no, that's not that important. What is important is my 6-week guest. Once every 6 weeks, I am blessed to have this guest in the program. He is my bond guru, the guy that has taught me pretty much everything I know about the bond markets. Forget my college degree. That was garbage. Actual real-world examples are how you learn. So we're going to do a bond market update. Certainly, we talked about the FOMC meeting yesterday. We'll see maybe a little bit deeper dive into what was said by Jerome Powell, not only at the announcement, but also at the press conference. Of course, I'm talking about none other than Mr. Bill Addiss. Bill, welcome back to the show, my friend. How you been?
I don't know how I can follow that introduction. Me and the Pope, and I took precedent. Thank you, sir.
You're welcome.
Good to see you and everyone.
Always a pleasure having you on. It is a pretty crazy day. I don't know if you. I don't know if you follow the political side of things, and obviously we have. Maybe we could talk about the Pope for a second. Are you a religious man?
3-year seminarian. I was a Jesuit seminarian student for 3 years.
Wow.
Yeah, in a former life.
I saw some pretty funny things today. I saw a statement that said the Chicago now has a pope, the first time ever an American pope, and they still can't get a quarterback to throw for over 4,000 yards in a season.
Now they have someone they can pray to.
Yeah, right. Oh, good stuff. Well, anyway, let's dive into our topic du jour, which is going to be interest rates, what Jerome Powell said. And you and I talked a little bit before the program, and honestly, I did not feel like there was anything that you go, oh, goodness gracious, wow, this is wild. It felt rather tame. Right. What's your take on it?
No, it was. And I almost felt like Jerome was being tutorial. I really thought in terms of explaining things, he did a much better job and seemed less stressed. Explaining the dual mandate, creating this problem for the Fed. What do they want to focus on, or what do they need to focus on? And he kind of described it as, what is the one that is most pressing now? And he went back to the pandemic, talking about what they had to do. So I thought he did a better job. And in doing so, he also uttered that magic word of stagflation. And I thought did a very good job of explaining, the tariff situations. We, the Fed, feel the tariffs are going to be inflationary. We feel the tariffs could result in a diminishing of GDP. I mean, everyone's pretty much acknowledged that. And I thought he did a very good job of clarifying that presents a problem for us. Which one do we address?
Yeah.
And I thought I don't know why, he just seemed less stressed. But I thought he did a very good job, even talking about the repo market, which, stagflation and repo are hardly exciting topics, but that is what the bond market is looking at these days.
Absolutely. It's funny because I always try to impersonate or give an idea as to what the questions might be, because I think we understand what some of them are going to be. And one of them, I was impersonating Steve Leisman, who did not ask the question I thought was going to happen. The question that he did ask was, which side of the mandate do you see needing urgent care first? And Let's look at those dual mandates. I'm sure you look at some of the data. Right now, we're at 4.2% on the unemployment rate. I can bring that up for the viewers if you would like to see it. Let me bring that up for you. And we received that announcement last Friday. That's your unemployment rate. Of course, there's many different data points, but you can see here 4.2%. And going back into 2022, it certainly has risen. I mean, we were down at lows of 3.4% in 2023, but it's remained relatively flat for like the last year, right around, let's say, 4.1 to 4.2. The other side of it was their second mandate is inflation. And of course, we could go back and look at that core PCE price index. Bear with me, folks, as I go and dig that one out and try to find exactly when that happened. But that core PCE price index showing actually deflation. We showed a negative number, which I thought was pretty surprising. Looks like they're editing it out now. But, we've been above zero for a long time, meaning inflation. Now, all of a sudden, it showed negative. They've adjusted apparently to zero, which means no inflation. But if those are the two mandates, do you see any one of those at this point that you say, well, this is going to need tending to first?
No, because the issue really, and this is where I thought he did a good job of trying to help people understand, the issue is what's going to be the impact going forward. It's almost like these numbers now, as President Trump has said, this is the Powell, this is the Biden market. Well, in a way, this is the Biden data.
Yeah.
Because the data you're looking at is all pre-tariff data.
Yep.
That's the reality. So this is going to be the benchmark of what are we going to be looking at post-tariff, or as tariffs are implemented. So we great when we get these numbers. We've got 2020 hindsight. That's great.
Yeah.
What Powell's worried about is what's going to be the impact going forward. So these numbers are the benchmark pre-tariff. But I think he's being very clear, saying we see a series of problems here, and the market is going to tell us what the mandate is.
Yeah.
The numbers are going to tell us. I mean, let's be honest. I hate using the word unprecedented, but I seem to use it a lot. First the pandemic, and now this. We don't have an economic models to base this on, short of some tariffs, as during the Harding days. I mean, hardly.
I don't know those days, my friend. That's a little. Yeah, it's a little before me.
I was already losing my mind and going senile during the Harding days. Imagine how I am by now. There's just not a lot to base it on other than theory. So he's being very honest, saying this is unprecedented. We have to see what the impact will be going forward. The heck with what's happened to now.
Yeah.
The issue is this hand grenade. I'm sorry, that's what I see it as. This hand grenade has been thrown into the markets. It's not even the hand grenade. We never know when it's going to go off.
And I would argue, actually embellish on that a little bit, because it's not a hand grenade. It's hand grenades. Right. It's and so many
Absolutely.
fronts, and it's interesting as a trader, as someone who's like taking this high level information and saying, how do I boil it down and make better trades off of it? My job is to be a risk manager first and foremost. And then I'm trying to concoct a plan based off this information as it comes in. And when you have such, I guess, data shocks, tsunami changes in whether it's immigration news, whether it's, fiscal policy, whether it's tariffs, whether it's taxation, it's like, oh my God, what happens here? It makes it very difficult. And I did notice that, Jerome Powell said something interesting that I took to heart, which was, look, the GDP data that just came out, we chalked that up to businesses trying to buy as much as possible before these tariffs hit, and that created this right. skewed data point. So we're not going to react to that, which, in my opinion, is the absolute right thing to do. I've been saying on the show for a long time, and I'm not a Fed member, unfortunately.
Next year comes the nomination.
Next year. So waiting is the prudent thing. We're at 4.5%. You saw what England did. They dropped theirs 25 basis points. So I'm sure that President Trump is going to have his Twitter feed chocked full of, well, they're lowering rates, so why don't we?
It's funny. I've had a couple of classes at OTA and with other clients since that announcement and so on. And the question always comes up, well, why aren't we cutting rates? The UK is cutting rates. And my answer, without trying to sound too snarky or too sarcastic, is I sound like my mother when I say, well, I don't care what the neighbor's kid did. What did you do?
Right.
The UK is operating on a different economy. European Central Bank, they dropped by 25 basis points. But the ECB is legitimately worried about a recession. They're a manufacturing economy. Their pressures and inputs and data are very different than the U.S. We're a consumer-driven economy. 65% of our GDP comes from the consumer. 65% of their GDP comes from manufacturing.
Right.
So the inputs, the data, the stimulus, just because one economy drops, that doesn't mean everybody should be dropping. Turkey raised by 2 percentage points last week. Why don't we raise by 2 percentage points?
Yeah.
So, we have to look at our economy and not look at our neighbors and feel some sort of political pressure. Because they dropped, we should drop.
Yeah.
It's different economies.
Yeah, that's true. But that'll always be the case. Like, well, especially when you're a president that wants your rates to be lowered.
Every president wants rates to be lowered. Let's
True.
This is a nonpartisan discussion.
Right.
Ask Jimmy Carter.
Absolutely. I want to get your feedback on something, because I don't look at the data as sharply as you do. I claim ignorance here, and I know you are much more focused on it. I'm bringing up for the viewers here the 10-year bond. And we know that the short end of the yield curve, your treasuries are, that's the Treasury Department and the Fed can influence those markets. Well, the Fed really. The long end, the 10, the 20, the 30, that's more driven by supply and demand. And we saw a few weeks back just a monster rise. Like really April 4th was just a colossal rise. And I think you'd agree that in a period of, let's say, 5 or 6 trading sessions, we rose 75 basis points. I mean, that's pretty significant for a free-floating market.
Yes, it is.
And the
Yes, it is.
speculation that I was hearing was that this was China going, oh, you want to tariff us? Well, screw you. We're unloading your bonds. What truth is there to that? Are you seeing anything that would say that China is unloading the 10 years?
No, there isn't at this point.
Okay,
There's
good.
not evidence. But I would point out for the last 2 years, though, coming out of the pandemic, China's been a net seller of treasuries, not a net buyer. The influence that China and Japan bring to the market just have not been that great. China's got about 800 billion of treasuries. That's as of last quarter. That's down from 1.2 trillion at their high. So they've been not a net buyer. So no, it doesn't surprise. But understand the reason that countries buy our treasuries is not for political reasons. Common misconception. It's simply economics.
Right.
They have a lot of dollars to invest. They're looking for places to get their dollars invested. So it's not politics. Now, I mean, yes, if somebody were to dump 800 billion in treasuries, would yields go higher? Yes. I
Right.
mean, the logic behind it is sound. It's just that China didn't do it. I mean, we're going to talk about later, our Fed owns $7
Yeah.
trillion worth of treasuries versus 800 billion for China. So China's not the influence they were in the 2000s and 2010 decade.
So that was the main talking point that I was hearing was that's why we saw such a surge in a short window of time was the politicizing, the weaponizing of bond products by China and Japan and others that were like, well, you're going to tariff us, well, take this. And honestly, I stepped back and went, well, that is a brilliant chess move, right? Because we want those yields to be as low as possible. Now, all of a sudden, by them flooding the market with these bonds, it makes our yields go significantly higher, which completely contradicts the savings we might get from tariffs.
Yes. No, the logic would be sound. They just don't have the impact that they would have had, and they haven't done that. They still got dollars to get invested. For them to invest in others to take a currency risk, if they wanted to move that portfolio from dollars to euros or dollars to something else. But they haven't.
Yeah.
And even if they did, I don't think it would be as dramatic as the impact would have been 10 or 20 years ago. That's for sure.
Absolutely. So before I get to my viewer questions, which I've got some good ones, what would you speculate would cause such a significant rally in the yields of those bonds? Because going into that announcement, really from March 27th through, let's get the exact date, through April 4th, which is 2 days after the Rose Garden speech that he made about reciprocal tariffs, we fell 12% in it. We fell 50 basis points in 6 days, which is like, okay, here we go. It looked like a head and shoulders pattern. I thought we were going to go much lower here. And all of a sudden, just face-ripping move to the upside. What would cause something that significant?
I don't know if you're familiar with an economist I used to work with, and I know quite well, Ed Yardeni.
No.
Yardeni Research. He's a constant talking head on Bloomberg these days. He's the flavor of the month. And Ed is always talking about the bond vigilantes, that there's a whole universe of bond people out there who just look for any opportunity to drive prices down and yields higher to get more value out of the market. And I think without oversimplifying it, the vigilantes took hold that week. But if you remember, the shock of that week was you can't just look at bonds in a microcosm because everything fell that week, remember?
Yeah.
We had equities down, we had bonds down, we had the dollar down. I mean, that doesn't happen. If interest rates are going higher, bond prices are going down, that should strengthen the dollar.
Yeah.
I mean, I think the real news from that period that you're talking about, and remember, this was when even President Trump was talking about, we got to make the bond people happy, or that Wednesday he said, even the bond market is satisfied.
Right.
Even Trump's looking at the bond market. But there was an uncoupling of our historical relationships. And I really do think the element of risk was put in the market. Mm-hmm. Based on what is going on, the dollar is a riskier investment.
Yeah.
Than where we were pre-tariff environment. And I think the market just kind of took a giant sneeze and repriced itself to that element of risk. I mean, these tariffs do scare people from an inflation point of view. And boy, the bond vigilantes took hold of that and drove yields substantially higher.
Yeah, from the peak when the announcement was made from the Rose Garden about all the reciprocal tariffs, the dollar had fallen to the low in April 21st, 6.03%, and that is a pretty substantial decline in 12 trading sessions. Now, just for perspective, what did the S&P do in that same window of time? It was a much more pronounced move. It fell 15.4%. So obviously, the dollar has much more weight than the S&P 500 on a global scale. So let's be clear there, but the S&P has also, from those lows to where we closed today, rallied 17.64%. And lo and behold, the dollar really hasn't rallied that much. I mean, it's up 2.78. It's still continuing this downtrend that really started at the beginning of the year, and it's looking weaker and weaker and weaker. So, I mean, that's crazy to think the dollar is a risk-on asset.
It hardly endorses current policies as being beneficial to the dollar. That's for sure. Absolutely. Let's be honest. I'm trying to be politically sensitive here.
That's okay.
The dollar's concerned about the risk of all this to the dollar. As you know, even the status of a reserve currency, you hear countries talking about it. And I can't say I blame them for having this discussion.
Yeah.
You know, we were the reserve currency in part because of our size and our dominance.
Right.
You know, that doesn't have to be held true forever.
No, people can respect you for a long time, but as soon as you start making enemies, things change very, very quickly. But let's be fair.
Downgrade soon. I'm sorry. Go ahead.
No. I was going to say, hey, we're now buddy with the UK again, right? We got our agreement there, our peace deal with them. I mean, that's huge. It's going to be huge. World changing here. Let's be honest. The UK is not our biggest trading partner, but
no. And in fact, we export more to them than we import from them. So hardly should be the high one on the leads list.
Absolutely. For those that are wondering, I did grab a cool screenshot here of this. So let me share with you, just so since we're tangentially on that topic. This is the agreement that was, or at least the deal that is in the works with the UK. Basically, they're talking about new market access to about $5 billion worth of exports. We'll get about $5 billion worth of tariff revenue. The UK will drop their tariffs from 5.1% to 1.8%. I thought that was interesting. And we're going to raise our tariffs from 3.4 to 10%. So, interesting deal. I don't know if it's a win-win, but you know what? I look at it this way. It's a piece of uncertainty that has been taken off the table a little bit. And it's not done, but at least we can go, okay, we've got that somewhat resolved over there. Now we can focus on the really important one, which is China and the European Union.
Right. Yeah, no, this is window dressing, but it's positive news. You know, I don't want to be too cynical. It's one check mark on the list done.
Yeah, absolutely. All right, let me see. I got some good questions that came through here. Margaret says,
I like your audience.
Realistically, will China at all stop buying our bonds? So they've slowed down. Maybe we can talk to why that slowdown has happened, if you have a thought on that.
They just don't have as many dollars as they did because they're doing transactions in other currencies.
Right.
So it's just that simple. You know. Also, their economy is obviously diminished over the last year and a half as well.
Yep.
So in terms of you know the revenue that they have to invest. I also, though, there's something I'm going to throw you a curve because we hadn't talked about this. The weakening dollar is actually having huge impact because going back to 2008 and then again during the pandemic, our Fed is doing currency swaps with 28 other nations. 28 other nations had done a derivative transaction where they would lend us their currency and we would lend them dollars on a swap.
Okay. Hold on. You called it a currency swap?
Currency swap.
Oh, currency. Okay, I thought my ears are messed up today.
I'm sorry.
No, okay.
My accent.
I was like, man, a currency. I learned something new today. Okay, yes, currency swap. Got it. Okay.
28 countries have engaged in a currency swap where they really felt it was in their interest to be holding dollars rather than their own currencies. Mm-hmm. And now, back in 2008, only 16 countries took advantage of this offer from our Fed. During the pandemic, the number jumped up to 28. They're getting hurt on that trade. We're making money on that trade, just I would point out. Our Fed's in a very profitable trade. They're basically short the dollar, long these other currencies.
And
how's that for a twist?
Well, would you call it
dollars, by the way?
Yeah,
trillions of dollars.
Would you call it a twist though when that's the goal of the Treasury Department, right? The Treasury Department likes to have a weak dollar, right? So does an administration because that fuels economic growth. So I don't think that's a surprise. It just kind of seems weird to think that they might be shorting the U.S. dollar. It's like, wait a minute, shouldn't you be supporting that dollar? No, they want economic growth, short that bad boy.
And this is part of the argument that says, you know, our Fed has kind of been the lender of last resort to the world.
Yeah.
You know, what we basically said during the last two economic crises is you feel more comfortable holding our dollars, we'll lend them to you. I mean, that basically makes us the lender to the world.
Yeah.
I don't know if we'll have that status on a going forward basis. We'll see.
Yeah, and we these other countries obviously have a choice, and I think that to your comments earlier about China and their dropping in our long-term bond holdings, it does speak volumes to them doing more international business. Just today you had Putin and Xi Jinping, getting together, and I'm sure forming some diplomatic alliance there and becoming a little bit closer because of our push to push them away a little bit. It's very interesting how this whole geopolitical world is going to shape up over the next couple of years.
Absolutely. And we've talked about OPEC. In the past, OPEC did all their transactions in dollars. So Saudi Arabia, Kuwait, these are countries I've worked with, helped them invest their dollars because they were selling oil in dollars. Now OPEC's doing oil transactions in rupees.
Or whatever currency they want.
Or whatever the local currency is. Exactly. India's the one who's really jumped up to the place. So these countries aren't going to have as much dollars to invest.
Yeah.
People like Ray Dalio have talked about this as kind of the real long-term clouds on the horizon.
Mm-hmm.
Unless our government curtails some spending, who ultimately is going to buy all these treasuries?
Yeah.
China's pulling back. OPEC nations are pulling back. If people have a real confidence of crisis, who's going to be our buyers?
Well,
and I don't see it as an immediate problem. I don't want people running around. I'm not trying to sound like Chicken Little.
No,
I'm talking about clouds on the horizon.
You don't want to sound like Ray Dalio?
Yeah, exactly.
I was going to say, I've got Oliver in my audience. He always gives me a hard time because he's like, I'm a negative Nancy and I'm a bearish guy in the markets. Look, you think I'm bad. You should watch Ray Dalio. Like, that clock will be right at some point, but he is always, the end of the world is coming. The biggest bear market in the history of mankind will be right around the corner. And he's probably right, but is that corner a year, a month, a decade, a century? It's just kind of comical.
Exactly.
I like his stuff. I do think he's got some very valid points. And I would almost say it's similar to my philosophy of trading is like, I could have a very bearish approach. Like, I could be the most bearish person in the markets, and I am fairly bearish now, but all my positions are long, and my mind says this market's going down. But until I get signals and actual proof that we are going down, I have to go with what the markets are giving me. And
absolutely,
I'm doing great.
I wholeheartedly agree.
Yeah, absolutely. I'm doing great being a bearish in my mind, but my actions are bullish in trading. So. No.
It sounds like you're mimicking my investment philosophy.
You have to.
Strategy.
Man, I'm sure that you would probably agree with this, that in your younger days when you're a little less astute with the markets, if you hold on to an opinion about what you think is going to happen and you're wrong, you could bankrupt yourself in no time. So exactly. I have no problem saying that. I know we're going to get a market crash. I know it as a fact, but I can't tell you when.
Right.
Another thing here that was a good question. Let me make sure I get this one right. Where was this China question? Oh boy, it ran away from me quickly. And I think it was Margaret says, "Have the bond act?" Oh, sorry, no. Where was the one about China? I believe it was someone asked if they're sniffing out recession. So are the bond? Here it is. It's from Andres. He says, "Is the bond market sniffing out stagflation?" So are they giving you clues that the bond market, or what clues would we look for from the bond market that stagflation is starting to be a growing concern?
Well, that's a great question, and it sets us right up for the yield curve that I sent you. Do you have the yield curve, both the blue and the yellow line, the curve since the last FOMC meeting?
I have whatever you like right here. I've got the changes since the last FOMC meeting is on screen.
All right, so let's look at that slide. So if you look what this is showing you is the blue line is the yield curve, the U.S. Treasury yield curve as of last night. The red line was the day of the last FOMC meeting. Mm-hmm. So meeting to meeting, what's happened to rates? And what you can clearly see on this curve is in the very short end, rates haven't changed at all. Out to 3 months, there's been no change. And the reason for that is the Fed didn't change policy. Right? They hold that end of the string. They control short rates. Nothing has happened there because the Fed didn't do anything. But then from 6 months to 1 to 3 years, you can see that rates have dropped rather, for a short period of time, rather dramatically.
Yeah.
And with this pricing in, quite frankly, because the yield curve is a forecasting tool. Yes, it tells you what rates are today, but it's really also a forecasting tool. And this drop, which, let's face it, looks like an inversion, is the market predicting that the Fed's going to drop rates after 6 months. That's what's being priced into the market.
Interesting.
So the marketplace in that regard is saying the Fed's going to have to, cut. The problem is, if you look, and it's no paradox, it's no mystery, look at where rates change from being down to being up.
Yeah.
Right at that magic 10-year.
Right
Right?
there,
That's the apex. So at 10 years, rates haven't moved at all in the last 6-8 weeks. But then the longer rates, 10 to 30, are also higher over that same time period. And what that is showing is the market is predicting inflation. See, long rates react to inflation expectations. And the higher rates you see there are that functionality. So we've got stagflation literally being priced into the market, that the Fed's going to be cutting rates because the economy is going to get hit, but that's going to result in inflation. Now, if that should not be the case, you could see those rates start to compress. And, again, everything is data determinant. But based on where we are now, the market is pricing in both a cut in rates and an increase in inflation. It's pricing in stagflation.
Interesting. Well, so there's your question. I answered it right there, Andres. It's a great question, because what sort of things do we look for? And I find it somewhat fascinating that really, if we look at this table here, going out to 6 months, really no big difference whatsoever, right? Just between our 1 month, 2 month, it's fairly flat line. And then really that 6 month point, as you mentioned, we see a significant decline. Really the 3 year is like, wow, why would I ever buy a 3 year bond right now? I'd rather buy the 10-year and get myself.
You shouldn't.
Yeah, you shouldn't be.
And I'll stress to your audience, if anybody has money to invest in the bond market, keep it short.
Yeah.
T-bills, that's where you want to be. Warren Buffett owns 5% of the T-bill market for a reason. That's where the value is today for cash and cash alternatives.
Wow, he's got 5%?
He owns 5% of the U.S. T-bill market.
That's got to be a pretty big sign that there's a lack of confidence in the equity markets, right? Because I think he's like at $375 billion. I'll verify that number for everybody here in just a second, but I think he's like $375 billion in cash. And in according to the number, it sounds like cash. It's not cash. It's T-bills, right? He's in short-term stuff with that, earning yield on it, obviously.
Yep. Yeah. I found that number was released at the conference this weekend, the Berkshire Hathaway.
Yeah.
5% of the T-bill market he owns.
Wow.
There's an indication of what he feels.
Yeah. Well, and I think they'll end up buying back in at some point, but when will that happen? On that note, what's your thoughts on Mr. Buffett stepping down? End of an era? Did you shed a tear? I know Larry was inconsolable, right? He's got a little altar at home with candles, and he's got.
Yeah, because let's be honest, he had a magic touch.
Yeah.
And we've seen people who have the magic touch, and when things change. And I'm thinking of Peter Lynch. Remember the old Peter Lynch days when he was such a maverick? And then as soon as he left, and Magellan Fund was managed by somebody else, everybody headed for the door.
Right.
I worry. I wouldn't want the job, because if you do a great job, you might be as good as Buffett. Anything else is going to be sub Buffett. I think it's kind of a no.
But let's play it fair here. Look, Warren Buffett and Charlie Munger were the two that were doing most of the work. But the misconception, I think, is that Warren Buffett's got an office and he's just rifling through all these numbers and he makes a decision.
Oh, God, no.
He's got a freaking team of hundreds of people doing the work for him, and he just says, okay, let's do that, right? And he might have a little input, but he's not the one doing the day-to-day stuff. So I would imagine that the guy taking over his position has been well-groomed with this team on goals and objectives. But you're right. There are some people that are going to go, it's no longer Berkshire Hathaway. It's something else.
Yeah. He's going to be under a microscope. But no, have you ever seen the buildings in Omaha, the Berkshire Hathaway buildings? He's got a lot of resources, that's for sure. It's not just he and Charlie kicking it around in the morning.
Yeah, well, there's an urn with Charlie, not anymore. Charlie.
Yeah, right, not anymore.
Yeah.
Sorry.
He lost respect for me when he said trading cryptocurrencies is the equivalent of trading freshly harvested baby brains. That's a direct quote from Charlie Munger. And I was like, you could say that I don't like trading cryptocurrency or it's a fraud or a scam, but to know your mind is that demented that you would say it's the equivalent of trading freshly harvested baby brains. Like, wow, what kind of sick individual comes up with that statement? I've never heard that before.
That's a darkness. Yeah. Really, that's a darkness to that. I don't want to investigate.
Oh, it was pretty bad. Here is the companies with the most cash. So I was wrong. It was not $375 billion. It's $347 billion in cash. And I mean, that's just incredible. And just for the audience here, just to give you an idea of monetary money, how much that is, I'll bring this video up here, and we'll go $347 billion. So there's million, there's billion, and you times that by, let's just be conservative and say 0.04. I'll even give them less than he should.
Yeah.
He's making $13.8 billion a year in guaranteed interest on treasuries. $13.8 billion just in interest.
But is he happy? That's really the question.
I think he's happy. I think he's a very happy man.
I think so too. But for those of us, I'm gonna be a commercial. We've been talking about the T-bill ladder strategies and all of that, and it just kind of reiterates, and it's not exciting, but the short end of the market is where the value is today.
It doesn't,
for income and safety.
We talk about that a bit here, and even with some of the strategies that I've been sharing with the audience. I have one of my portfolios I share with the group here, which is basically a wheel strategy, which is not exciting. It's not designed to be exciting. It's designed to be consistent. And you did some videos on the bond barbells. You did some on the bond ladders, and I think there's different times for those different strategies.
Right.
And that is all covered in your Canary in the Coal Mine course, correct?
That is it. Thank you for the plug. But look at that yield on the 1 month T-bill. That's very attractive. You got to go out longer than 10 years to get the same yield you get by investing for 1 month. That's an opportunity.
Yeah, that's crazy. It's shocking to think that you could get paid the same amount. And for those that understand bonds, just think of it as the longer you invest your money, the greater rate of return you should be getting, right? That's the general principle with rate of return. Like if I'm going to lock up my money for a longer, just like a CD, right? If you do a 1 month CD, you might make a small amount, but if you do a year CD, they'll give you a little bit more typically. This is if I were to buy a treasury for, let's say, 1 month, I'm going to get 4.3%, but I buy a 10-year bond, I'm going to get 4.2. I make less in locking my money for 10 years. That's not a good sign from the economy. This should be normally should be sloping from the bottom left to the upper right is the way a yield curve should look. And this is broken. This tells us, and again, this big dip in the middle tells us there's a problem. There's a problem coming.
Yep. But I stress that broken represents an opportunity. I really do believe that.
We love opportunities. More and more opportunities.
It's not exciting.
No.
Warren Buffett's not exciting, but he owns 5% of the market that I'm advocating here.
Yeah. Well, he also, can make billions of dollars just by holding those bonds. Many people may not be able to sustain a living off of 4%, right? And this is one thing that we talk about with this.
Oh, absolutely.
One of the things.
Sorry.
No, it's okay. You're great. It just sometimes these thoughts are in my head and I lose it if I don't spit it out right away. My senior moments are coming, Mr. Addis.
Sorry.
One of the things that was interesting about the strategic investor class is, one of the first day in the physical class, I remember we sat down and the instructor said, "What rate of return do you need to achieve your financial goals?" And it's an interesting question. Right. I would argue most people don't know what that number is. Like, what exactly is that number? And once you calculate it all out, mine was actually a lot lower than I thought it was. Still very achievable, that's for sure. But if you know that your number is 3% rate of return on your capital for, then you're set, then you should never even get in the stock market. You should just buy the 10-year bond right now, lock in 4.25%, and know you're going to be making 1% more than you need to, and you're happy. So
exactly.
Love bonds.
But let's face it, most people are not in that situation, hence the need for managing risk.
That is very true. Very true.
Yep.
Talk to us about what the Fed is doing with its balance sheet, because one of the things that I've seen on social media, and it's kind of driving me nuts, is all these younger people, and even older people that just have no clue about the markets. They are spewing out this information that quantitative easing is now upon us, and that they gleaned that from the meeting yesterday. Oh, well, quantitative easing is here again. We're firing up the printing presses, and I want you to solidify the truth here, because you're the truth.
Okay. No, you're right. And that is the buzz that's out there, and it's just wrong, quite frankly. So, just as a reminder to the group, so during the pandemic, what the Fed decided to do, because we're that consumer-based economy, is the Fed decided that they were going to have lots of stimulus, right? They went in and they literally created over a year, $6 trillion of new cash, and used that new cash to buy treasuries. That was what QE was all about. So they literally dumped $6 trillion of new cash into our economy. As we've talked at numerous times, as you know, Merlin, we were swimming in cash.
Yep.
Literally. I mean, M1 increased by 500%. We had all this money. But the Fed decided we have to do this as a way of getting the consumers to spend their way out of the pandemic. And it worked.
Yep.
I mean, by every measurement, it worked. But we've got this problem of all this cash out there. So what the Fed has been doing since the pandemic bad days were behind us is they switched strategies and they then initiated tapering. And tapering is the opposite of easing. And literally under tapering, when they first started, the Fed made a commitment to take $120 billion in cash out of the market, out of the economy every month. Literally destroy it. Just like the Fed can create money. Money supply here in the US is not controlled by the government. Common misconception.
Right.
The Fed controls it. And when they injected all this cash in the economy, who in the government approved it? Nobody. They had the authority to do it. Then when the Fed turned around and said, we're going to destroy $120 billion a month, again, they have the authority to do that. Well, that number has been diminishing over time. Now, when they had such a high target of 120 million, now think of it, the Fed had this largest portfolio in the world. They had about $8 trillion worth of treasuries from all of these buying programs they've done since the last recession and the pandemic. So they had earning a huge amount of interest on that. So the first thing they were doing is the interest that they got paid, they were destroying that money every month.
Right.
But that wasn't 120 billion. So on those months, when they didn't get enough interest payments, they were literally going into the market, selling treasuries, and then destroying the proceeds.
Mm-hmm.
So one way or the other, they were getting 120 billion, even if it meant they had to sell their treasuries. Well, that number has diminished over time. They went from 120 billion down to 90 billion, down to 65 billion. And again, the whole purpose here is to destroy all this excess money that's floating around in our economy. And they've been successful at it to a certain extent. Do you have the balance sheet slide there? I can't see.
I will bring it up. Right. I was looking at I was looking at the different roll-offs, but there's the Fed balance sheet.
Well, yeah. So then we'll get into the roll-off. So what's happening now is at the last Fed meeting, the Fed announced we're going to drop the number to, I think it's 35 billion. I've got it on the previous slide. Sorry, they're going to drop it to 35 billion a month in their mortgage portfolio. See, the Fed owns a portfolio of treasuries and mortgage-backed bonds. So the first 35 billion that comes in on mortgages, they're going to destroy that.
Good.
Now remember, mortgages pay their principal every month.
Right.
So they're basically saying the principal they get back on their mortgages, they're not rolling it back into the market. 35 billion they're going to take off the table, if that makes sense.
Yep.
And on their treasury portfolio, which is actually the larger portfolio, they're going to take $5 billion worth of maturing treasuries and not reinvest them back into the market.
Right.
They're not going to be, so they're not, and that's called tightening, by the way. The distinction they're making is when the Fed had to sell treasuries, that was tightening. When the Fed is just letting the roll-offs not occur and, not being as active a reinvestor, that's being referred to as quantitative tightening, not tapering. The terminology has changed a bit over time. So they're not, but here again, the Fed's not as active a participant in the new issue market. Normally, when a treasury matures that they're holding, they just reinvest it back in a new treasury. Now they're going to take some of that money off the table.
Yeah, and it's interesting because you have on the screen here, it says the Fed will continue to reduce its balance sheet by $5 billion. That number has dropped significantly. I mean, it was much higher than that.
Oh, that was at 60 billion.
Right.
Yeah, no, when the Fed was 120 billion, and when we first came out of the pandemic, it was evenly split between mortgages and treasuries. Yeah. So, and you think about it, when your biggest buyer, because that's what the Fed was during the pandemic. During the pandemic, the Fed was the biggest buyer of treasuries, and I'm getting way too excited about this. I hear my voice getting excited.
It's all right. We don't mind.
My voice actually just squeaked a moment ago. I got to get a life. But when they were doing that, they were doing $13.5 billion a day.
That's crazy.
Of purchasing.
Yeah.
That's crazy.
That's insane.
Now, think about what happens when your biggest buyer becomes your biggest seller.
Yeah, right.
Is it any wonder that long-term rates have gone up?
Yeah. Yeah, and especially,
during that period.
Right. And if you couple that with, the other component, which is, okay, we're selling it, but also some other people might be selling it, you could see some big surges there. $35 billion on the mortgage-backed securities. I, for one, am of the belief that should be at zero. They shouldn't have a mortgage-backed security balance sheet as at anything. How much is left on that? Do you know?
It's funny you raised that question because as I was just looking at this, it was a number that came in my head. And I should explain to the audience, the Fed started supplementing and supporting the mortgage market back in 2008. when we had the mortgage crisis, we all saw The Big Short.
Yep.
When we
Great
had
movie.
the mortgage crisis, yeah, great movie and an even better book. I highly recommend the book. Gets into a lot more detail. But the movie was fun and educational. But when the mortgage crisis was this catalyst, the Fed stepped in and started buying all that garbage mortgage paper. They were literally taking the risk off the banks. And, on the one hand, I say, well, that's, I guess, good. But I also have to point out the Fed is owned by the banks. I think this is one of those examples of a little bit of a conflict of interest. So the Fed said, we'll step up, we'll use our capital to buy all these garbage mortgages. And they continue with that buying program after the recession was over. And during the pandemic, the Fed was in being an aggressive buyer of mortgages.
Right.
And, you've raised the question, I've heard it. I raised the same question. Why?
Yeah, why?
We didn't have a mortgage crisis during the pandemic, right? Real estate values were taken off. Even mortgage money was relatively available. There was no mortgage crisis. Why does the Fed continue to be a supporter of the mortgage market? I have to say, I think one of the answers is they're helping their owners.
Yeah.
They're supporting their owners.
Well, it really helps the wealthy. Like, it is one of those things that ultimately absolutely helps the wealthy. And not necessarily wealthy, but those that can afford a home. Because if you're a homeowner, you're like, hell yeah, Fed, keep buying mortgage-backed securities.
Right.
Prop this market up.
Right. Exactly. But, and I could understand that in 2008. I really could. The Fed was stepping in because we had a mortgage crisis. We haven't had a mortgage crisis in a decade. Why is the Fed still such an active buyer?
Right.
I really have a problem with this.
Me too. And here's a chart to really drive this home for everybody. This is a chart of it's the S&P Case-Shiller Composite 20 Home Price Index, which gives you the price of homes in 20 major metropolitan areas. And you can see why they're buying mortgage-backed securities in 2008. We were watching massive loss of value, absolute collapse of housing prices. But you could make the argument that in 2013, when we were back to seeing 10, 12, 13% year-over-year gains in home prices, they should have cut that out right away. And we maintained that level for a long time. When we surged here in 2020 and got up to 20% year-over-year growth, the Fed should have been long gone. That should have been the perfect time to unload those things. Perfect time. But nope.
I absolutely agree.
Crazy that stuff happened. Let's see, what other questions? Bill, I think this is to you. Are you planning to open the course on EDX Understanding the Federal Reserve? I'm not sure if I understand you.
Opening on EDX.
He's got a course at Trading Academy. That's where he teaches. He teaches for the retail people. He's got some stuff on his website, but also teaches at Trading Academy. And on the institutional side, which unfortunately, and not sound condescending, you guys won't have the opportunity to get into those classes. That's for the new breed out of college learning these markets. He'll teach for some of the major banks and brokerage firms, but we will not have access to that, unfortunately.
Yeah, sorry about that.
It's all good.
Yes, but on my website, and you're hosting some of these videos, Merlin.
Yeah,
I do have some of those old websites we had. So there is some Fed videos on my website, but it is also a big part of the focus classes we mentioned. You can't. In today's world, you can't talk about bonds. Heck, you can't even talk about equities without talking about the Fed these days. So we do focus on the Fed. And how they stimulate and affect all the different asset categories. Absolutely. No, I wish I had more resources, but honestly, most of my business is institutionally oriented.
Yeah.
But you guys, I so love working with you guys.
We love it.
You guys are a heck of a lot more fun than my institutional clients. They're boring.
It took a while to get you on board, but I'm glad it finally worked out. Quick question here coming up from a couple different people about SGov, which is a short-term bond fund. I know that you talk a lot about in your bond program, how do you buy them direct? And obviously, when you buy them direct, you save yourself on a bunch of fees that a lot of these ETFs will bundle into the packages. But SGov or SHY, what's your thoughts on SGov as a good short-term bond fund?
So here's my general problem with bond funds, and this is kind of the intro to the focus classes. I do believe that more retail investors could and should directly invest in bonds themselves. If you are the traditional bond buyer, what we call the coupon clipper, my grandmother, she bought bonds, she lived on income, she wasn't selling them, she wasn't trading them, think the traditional bond buyer. I think there's a place for them to buy bonds individually.
Yeah.
Most brokers offer you bonds. People just don't know to ask.
Right.
So in the class, we get over how to do that. And the benefit of doing that, obviously, is why pay somebody a fee to do something you can do yourself with a little bit of homework, if you're willing.
Yep.
The problem I have is if you're looking to trade the market, I don't recommend buying individual bonds because they're actually rather illiquid as in reference to the retail investor. because bonds don't trade on exchanges anywhere here in the US.
Right.
It's completely an over-the-counter market. So if you're doing business with Schwab and you're looking to buy or sell a bond, you're only getting Schwab's price.
Yeah.
There's no guarantee that's the best price in the market. And honestly, for the retail investor, the difference between the bid and the ask, you can drive a truck through that sometimes. So to trade the market is rather cumbersome. That's why I love ETFs. I love bond ETFs for the trading purposes, because we're taking a relatively illiquid asset, repackaging it into a fund, and putting it on the exchange to give us centralized trading, liquidity, transparency, all of that. So if you want to trade the market, I strongly encourage you to look at bond ETFs. Also, then I'm sorry to make this a long answer. The problem I have with bond ETFs is most of them, now some of them are changing now, most of them are perpetual securities.
Right.
And you don't have a maturity. And for many investors, that maturity is a nice feature. My grandmother knew when she was going to get her money back to reinvest back into the market based on the maturity of the bonds that I bought her. You buy an ETF, it's a perpetual.
Right.
TLT, we talk about these in the classes all the time. TLT is a portfolio of 20-year maturity bonds. Well, what BlackRock is doing is when a bond becomes a 19-year maturity, they have to sell it and replace it with another 20-year, because that portfolio only has 20-year bonds. So you don't have a maturity. So again, it's good and bad. You're getting much enhanced liquidity, price transparency, all those good things. But by doing it in ETF form or fund form, you lose that key benefit of knowing when you're going to get your money back.
Yeah.
If that makes sense.
Yeah, absolutely. And
so it's kind of
yeah, and I think there's a lot of other considerations here. Obviously, there's a taxation side, and Big Eb asked about this. He says, do those bond ETFs incur state taxes?
They're fully most of them are fully taxable. Oh, no. TLT. I'm sorry. I was talking about TLT. Yes, state tax exemption.
For municipals, yes, but
yes, and for treasuries also. Yes, yes to both. I'm sorry. Mental lapse there for a moment.
So municipals are tax-free, and that's one of the big reasons people go to them. And you're saying TLT as well.
State, because it's all treasuries. That's correct. Cool. The IEF, the IEI, these are the BlackRock big ones. They're all 100% treasuries, so that benefit passes through.
And Big Eb says, whereas T-bills direct purchase are state tax-free. Yeah.
Yes. Well, that's all treasuries. That's what we're saying to all. Just to make sure. Treasuries are only exempt at the state and local level. Treasuries are taxable at the federal level.
Right.
Municipals can be triple tax-free depending on your location.
Right, and depending on which municipality it is.
Exactly, right. But yeah, treasuries, whether it's T-bills, T-notes, or T-bonds, the government, federal, is going to tax you. You're exempt from state and local if that's appropriate to where you live.
I have a gentleman wants to know, I said you should talk about that in your upcoming XLT. Maybe you will. What's your upcoming XLTs coming up soon here, right? Yes.
We've got the 28th of the month. So I've got the 28th. We've got the hour-and-a-half monthly XLT session. And I try and appeal to both constituencies. In my classes, I've got people who want to understand bonds for income, and they want to understand bonds for trading. So the good news on the income side for just a moment is certain asset categories, that 3 weeks ago when we talked about the repricing in the market that we started this session with, the real repricing was actually in corporate bonds and muni bonds. Those yields went up dramatically in that same time period, and they've stayed higher. So the credit spread, the yield you're getting on credit product like corporates and munis is actually starting to look attractive again. I mean, they have not looked attractive since the pandemic. I've been saying in my classes, I'm educating you on corporate bonds. Please don't feel that I'm, recommending them necessarily. Well, the yields are getting to a point where, not that it's my place to recommend it, but if you're looking for credit, yields are now attractive again. So we talk about that, where the muni buyers and the corporate buyers are finally getting some income, but then we also got to discuss the trading side.
Right.
And there's a lot of volatility going on in this market that provides trading opportunities.
And it's not going to stop anytime soon.
Yeah, right. It's certainly, I don't see it. But let's face it, that's to our benefit.
Yeah, absolutely.
In my life as a trader, on the street, my worst market was a quiet market.
Yeah.
Can't make any money there.
Totally agree. If you guys want to know more, you can go to, if you are a Trading Academy graduate, just go to my OTA. You click on the calendar there, and you'll see all the different classes that are going on a daily basis. And there's a lot here, but you can always search by instructor's names. So if you just type in ADDISS and hit enter, You'll see Bill's schedule. You can see on Fridays is when he does his Canary in the Coal Mine Focus class, which is every Friday at 11 a.m. And then here's the next XLT, which will be at 10:30 in the morning Pacific time on the 28th of this month. So check the calendar there, guys. You can find out more information about that and upcoming speaking engagements. You can also go to aftraining.co. I had that as lower third there, which I'll bring it back, but aftraining.co. There's all kinds of information there. You click on the media section. You got a bunch of great videos, some of which I had interviewed Bill many years ago, so we both look a little younger there. Less gray hair.
Yeah, but the Fed hasn't changed, right? Their mandates are the same.
That's
so
right.
It's still as current today.
They have not changed. It's all current. It's all, these markets just slowly evolve. Anyway, well, hey, thank you very much. I appreciate you taking the time out of your schedule to join us today and shed some light into this whole bond market, the outlook of it, and the road ahead is very uncertain. Maybe bonds play a part in that portfolio.
Data determinant. We're all going to have that inked on our forehead. Data determinant from this point on.
And I think it's the right way to be. So cheers to Powell. Next time you have lunch with Powell, tell him I think he's doing a decent job.
Yeah, I'll let you know what you think.
Yeah, you got it. I appreciate it. Hey, Bill, thank you very much for coming on. I appreciate it. Take care, my friend. We'll see you soon.
Always a pleasure.
Right, take care.
Really enjoy working with you, Merlin. Have a great weekend.
You too. Bye-bye.
And my best to everybody. Good questions. Bye now.
All right, guys, that was Bill Addiss. You can find out his class at Trading Academy. He's got, that's the only retail one he's got. He's got some videos on his website, which you can check out. I just mentioned that as well. So here we go. Yes, Bitcoin pumping. You talk about crypto is ripping right now, and I'm loving it. We are seeing some pretty nice moves. I'll wrap up here with just that. I'm trying to keep things in my normal time frame as I got a 3 o'clock meeting here. But there's that breakout we talked about with Bitcoin. Your futures looking great. Certainly pulled back a little bit here, but the Bitcoin futures rallied all the way up over 103,000 today. That's stark contrast to closing at 96,000 yesterday. So a pretty big run there today for Bitcoin, as you can see percentage-wise, the big gainer. But right on the heels of Bitcoin, crude oil. We talked about crude oil just still in that big downtrend, maybe bottoming out around 55 on that double bottom formation there, and there we go. Today, kind of an about face with this big green candle up 3.17%. A lot of green. Actually, this was a very risk-on type of day. Even the yield surging 2.6% for that 10-year bond, which, of course, we talked about today. But the indexes looking pretty good. Russell's up 1.9% and is still continuing its great uptrend here off those lows in early April. NASDAQ up 0.94%. Same thing, looking pretty. Let me get rid of this old line here. Looking pretty good today, although it did not close above the most recent highs from Friday and Monday. But still, 0.94%, not too shabby for the NASDAQ. I do think you're going to have a little bit of a difficulty once it gets back to this high right around 20,500 on the NASDAQ 100. Dollar index up 0.76. This one's important. We talked about that channeling. Today was a good day for the dollar, at least from a value gain perspective, not necessarily for those of you that are doing business in the United States. But we did break above this yellow band right here at the top, right? Broke above 100.27. That was my line in the sand, and now we've broken it. And if you look at that chart to the left, where is it going to go? You could break this down into a smaller time frame, maybe an hourly time frame, and see if you could find something in there that acts as a good supply zone, maybe around that 101 mark. But after that, it's like you're almost smooth sailing all the way up to right around 103. So not the best picture for those of you that are bearish on the dollar, which I have been bearish on the dollar, and I still think that they're going to try to push it down. But this is a very positive sign. Higher highs, higher lows intact right now for the dollar index since late April. All right, this is late April, which was just a few weeks ago. Now, let's go further down the list. Still positive with 0.58%, and I've been outlining this level here on the S&P, which was 57.12. Now, today we did break that. We ripped above that. We hit 57.41, and then all of a sudden came right back down. And you can see here on the 5-minute time frame, right as we went into the close, things started to look pretty weak. Just the last hour was a pretty aggressive sell-off there for the dollar index, which gave back some of the gains, but still closing up 0.58%. And a little bit down in the after-hours session. So all in all, a pretty decent day, although we did not close above my top green line here on the S&P. And lastly, gold. When money's pouring into equities and pouring into in crypto, probably going to see it coming out of gold, and therefore second down day in a row. We're down 2.53% for gold today. So there we go. All right. Thought we'll go the opposite because the deal didn't go through, but no, because everyone is flooding to Bitcoin now. And I think that this I think it's that moment. Again, I don't know why Bitcoin was selling off. I have a feeling it was fractional reserve banking. But with all this landslide of positive news for Bitcoin and digital assets, really, it was just bound to happen. And maybe this is that catalyst that now sends us to that 250 mark that I've been looking at. Again, every day that goes by, so the greater percentage rate of return in a shorter period of time needs to happen. So I'm pretty excited about what happened there in Bitcoin. Nice moves today. And it's not just Bitcoin. If we look at the crypto market, I'll go to my crypto tab here. I mean, Pepe Coin, which is absolute garbage, 35% gain. Sui, which is a great project, up 20% in the last 24 hours. Ethereum, which, again, I second largest position in my portfolio, monster move up in Ethereum. This is a great thing. You had Near, Arbitrum, Optimism, all up 15% or more. I mean, this is a great day for my long-term portfolio. The only two things that are down is Pax Gold, because it's a gold coin, and Bitcoin's dominance. This is Bitcoin's dominance in the crypto space. You can see it just becoming more and more dominant as more people realize that Bitcoin is the answer. But now today, a big drop in that is a lot of these meme coins and altcoins just rallied significantly. Solana up 8%, Ripple up 8%. Great day overall. That's by Fartcoin, yeah. Oh man, the stupidity that goes on in crypto. I mean, Fartcoin's up 20% today. Again, it does nothing. So while there's good stuff that happened in crypto, there's this idiocracy that happens as well. And well, part of my crypto program is I don't talk about that garbage. I stay away from it. How is DJT? DJT is doing okay. We're at $25 right now. Let's zoom out here. Yeah, still not great. I don't expect great things to happen from DJT, but it's stabilized, and now they're doing multiple ETFs they're trying to release. They're also getting involved with different crypto projects. So, they're doing the right things, trying to expand and differentiate their business model a little bit, but yeah, still around with old D to the J to the T. All right, let's go economic calendar for tomorrow. Let's wrap this show up. Let me remove my filter here because I created a filter for U.S. markets. Going to Friday session. Oh, Friday. It's hard to believe it's actually Friday already. You can see we've got a tremendous amount of FOMC statements. Again, this is going to create a lot of volatility. You just don't know which way it's going to go. You've got Barkin, Williams, Gooseby, Waller, Cook, Hammock, and Masalam all speaking tomorrow, including Barr and Kugler. So, I mean, pretty much everybody there is speaking tomorrow from the Fed, giving their thoughts on where rates are, inflation, and that sort of thing. So keep an eye on that. It could be very volatile. When you see wild swings, could be any one of them making a statement. And that's pretty much it. And then the earnings front tomorrow, if I remember correctly, this is testing my brain right now, and I can't seem to rein it in. There's one company, and I want to say it's a healthcare company. I think it's hold on, I'm bringing it up right now. I think we got a healthcare company reporting tomorrow. Let's see. The big one for tomorrow is, Toyota Motor. No, that's today. There it is, HMS, Honda Motors. I knew I had it close. A lot of these are international, and I don't look at that as being very impactful, but Honda Motors reporting earnings tomorrow. Even though they're international, I'd be interested to see how they pan out, what their earnings look like. All right, what'd you say there, Chad? Meme coins, some say, are the best for trading because of all extrinsic, but need to have a future on them to trade both ways. Yeah, they're great trading vehicles, but it's nothing that's going to be long-term. I mean, all meme coins will go to zero at some point, especially once the regulators come in and say, enough, get rid of these meme coins, which I think will happen in a few years. I thought Mara would rip today. You would think that because of its ties to Bitcoin and Bitcoin now breaking out, that things like Mara, which is up, it's up 7%, so not too, it's up more than Bitcoin. You also have Hut 8. Hut 8 was up 11.93%. You've got Riot. So the miners did well, 7.65% move up for Riot, and that's more than what you saw with Bitcoin. Bitcoin was not up that much. So yeah, you could also look at MSTR. MicroStrategy was up 5.5%, also up another 1.4%. Of course, now I'm regretting getting out at 377 on this bad boy, but it is what it is. I still have puts that I've been selling on it, collecting premium, but man, would have been a much bigger gain if I just kept up. I know, Big Ed, Pepe up 35% today. Ridiculous. All right, guys, that's going to do it for me. I hope you enjoyed, Bill. Hope you enjoyed a 1-hour show today. Tomorrow will be Friday. and I will gladly have a glass of whiskey. It's been a great week for me, honestly. All my trades have done very well, so I had a pretty good trading week. Well, knocking on wood, I haven't finished the week yet, but all in all, things seem to have done pretty good on all my options trades. I only had one equity or futures trade this week, which was not that big of a deal. Small winner, nothing to write home about. So we'll wrap things up on tomorrow's show. Again, if you want to see Bill Addiss in action, he teaches over at Trading Academy. That's his only real retail education point. So if you go to Trading Academy, you can log in and find out information about his Canary in the Coal Mine Bond Focus class, which he teaches every Friday at 11 o'clock. And then last week, he actually had the full class, which is like an 8-hour class or 6.5-hour class. So a lot of work. Cool. That's going to do it for me. If you guys have comments, questions, feedback, things you want to talk about, email me at tradermerlin@gmail.com or put it down below the YouTube video. Take care, everyone. I will see you all tomorrow.